Good afternoon, everyone. On behalf of the management of Megaworld Corporation, also known as MEG, and BDO Securities, thank you for joining us in another BDO Securities corporate series. I'm Marco Mauleon, BDO Securities Research Analyst, and I will be your host and moderator for this afternoon's event. Allow me to share some reminders before we proceed. We will be entertaining questions right after the presentation. Should you have your questions, you may send it anytime through the Q&A box on your Zoom screen options. To formally begin our program, let me call on Video Securities Head of Sales and Marketing, Boom Bondok, for his opening remarks.
Thank you, Marco. I'll keep this short. So again, welcome to another episode of our Trade Talks corporate series. And like what Marco said today, we're very excited to have our friends from Megaworld to again give you, our clients, first-hand access to information as well as to the clients and to the company's decision makers. So with that being said, again, take advantage of this, ask your questions, and enjoy the rest of the session.
Thank you, Boom, for welcoming everyone. Before we get into the presentation proper, let me first introduce our distinguished guest. We are honored to have with us Andy De La Cruz, Head of Investor Relations for Megaworld Corporation. Now, without further ado, let us all welcome Andy.
Hi, Marco. Hi, everyone. Thank you for having me. I guess we'd like to start this off with a presentation to begin a discussion to this afternoon. So I'd like to start things off with a brief run-through of Megaworld's history. So we were incorporated in 1989, so a very young company compared to other peers. In 1996, we launched our first ever township that really paved the way for what Megaworld is today, Eastwood City, which I'm sure everyone here is very familiar with. The land Eastwood City is in used to be an old textile mills factory, but as Megaworld bought that 11.5 hectare land and developed it, we launched Eastwood City in 1996 and is our first live, work, play community ever. Now, the 18.5 hectare Eastwood City has a total of 9,000 residential units across 23 buildings. We have 236,000 square meters of office leasable space. And that's across 11 PEZA accredited buildings, 64,000 retail GLA covering 3 malls in various retail spaces, and 138 hotel room keys and function rooms with a max capacity of 500 seats. And in 1997, we first introduced the affordability model of flexible payment terms for pre-selling condominiums in the Philippines. We also spearheaded and paved the way for the start of the BPO boom in the Philippines, as we are the first one to apply for PEZA accreditation. For that, Dr. Andrew Tan, our CEO, and the team sent teams to Bangalore, India, and Silicon Valley to really study the booming IT sector during that period in order to bring the knowledge back to the Philippines. Here you can see several townships we launched, McKinley Hill and Newport City in 2004 to 2005, McKinley West and Uptown Bonifacio in 2010 to 2011, Mactan New Town, Davao Park District, Twin Lakes in 2012, Iloilo Business Park in 2013, and many more. So I'm sure all of these names are very familiar. And in 2016, we launched Maple Grove. This is positioned as a green city in the South. In 2018, we launched iTownship campaign to promote the future-ready townships. This includes being energy efficient by having solar-powered lamps, plans to use electric cars as PUVs, double-glazed buildings, and the like. This will also include smart technology, safety, and security, among others. We also inaugurated our first school venture in partnership with LaSalle in Visayas, the Newtown School of Excellence in the Mactao, Newtown, Cebu. That's in 2018. In 2019 and 2020, we formalized our vision, mission, value statement with the forming of a sustainability team that will ensure the group will be carbon neutral by 2035. In 2021, we listed MREIT. And finally, we also launched our Township Analytics and Technology Lab that is really aimed at increasing the safety and security of Megaworld Township nationwide. This lab, the TAT Lab, is the first ever data science lab spearheaded by a property development company in Asia. So this will be designed to develop, deploy, and improve machine learning models and AI aimed at increasing the level of safety and security of Megaworld townships nationwide. Megaworld will be using AI to introduce innovative programs, which include an advanced accident detection system that can detect road accidents and trigger a faster, more efficient incident response. Moving on to our next slide. So in just only a short span, we now have 30 townships all over the Philippines, covering more than 5,000 hectares. We still have available land bank of more than 5,000 hectares as well that is sufficient to support our land development efforts for the next 15 to 20 years. Now, to quickly discuss our key segments as a business, first is real estate, our biggest business operations. Real estate sales increased 18% year on year to 36.8 billion in 2022. The strong demand we saw during the third quarter maintained its momentum into the fourth quarter last year, and reservation sales in 2022 reached 119 billion. This exceeded our revised reservation sales target of 110 billion earlier, late last year. Project launches for the period stood at 45 billion, also exceeding our 35 billion target this year. Moving on now to the performance of our office segment. Office rentals for the period grew 11% to 12.2 billion, while our GLA remained largely unchanged at 1.4 million square meters. Our occupancy rate stands at 92% as of end 2022. That's an improvement of 200 basis points or 2 percentage points from our year ago levels of 90%. This is despite the increasing vacancies in the industry in 2022. Our occupancy rate is also higher than the industry's 80 to 81% average occupancy rate. Our office transactions for the year also ended higher by 9% at 258,000 square meters as the team actively closed leases from all fronts, especially the rising demand from SMEs and the like. Now for our mall segment, mall revenues in 2022 saw a 51% increase to 3.4 billion on improving spend, and as we continue to increase our fixed rent collection and really decreasing our discounts to rents. As of December, we collected 90% of normal rent. And beginning January of this year, this 2023, we already removed all of our rent discounts and concessions as we move toward a full recovery of our mall segment this 2023. We grew our retail GLA by 5% to 484,000 square meters in 2022. Occupancy rate also improved, similar to our office, improved by 3 percentage points to 90% as of end 2022. Average daily spend of mall goers grew by 2% in 2022 compared to year-ago levels, which is also already around 30% higher than pre-pandemic levels already. Total tenant sales in 2022 is also already 6% higher than pre-pandemic levels. And supermarkets and entertainment tenants were really the strongest performers in 2022 and continue to grow beyond 2019 levels. Moving on with Megaworld Hotels and Resorts. So hotel revenues jumped by 35% year on year to 2.6 billion, with 64% occupancy rates from our 4,700 room keys. Our revenues in hotels improved overall and is already above 2% above 2019 levels. So it's a full recovery there. Aside from improved overall occupancy, our room rates also improved, and our best performing hotel is our Twin Lakes Hotel in our Twin Lakes Township in Tagaytay. Effective pricing strategies really during 2022 allowed for almost doubling of average daily rates versus pre-pandemic levels. Hotel occupancy also improved because of our continued brand building efforts. And finally, we'd like to give you a breakdown of our future projects and launches for this year and beyond. Megaworld will launch 3 townships this year across different areas, 2 in Luzon and 1 in Mindanao. We expect to spend 55 billion pesos in capex this 2023, 80% of which is for our project development, while remaining will be for land acquisitions. We plan to fund this with a mix of internal generated cash and borrowings. Will be short-term should interest rates continue to be on the high side, and we will have an active move to minimize our exposure to foreign currency. This year, we are targeting to launch 60 billion worth of projects across 20 projects to help us reach our 130 billion reservation sales target. For our office pipeline, we expect to grow our portfolio by 207,000 square meters of GLA, or by 15% until 2026. These will be in 5 different townships of Megaworld, namely the Upper East Bacolod, Uptown Bonifacio in Taguig City, Iloilo Business Park, Capital Town Pampanga, and McKinley West in Taguig City. The largest building is the International Finance Center at 69,000 square meters, which is located at Uptown Bonifacio. And as of end 2022, the building is 50% pre-leased. Beyond this list, we also have future pipelines still in the planning stage. But we also like to present to you our mall pipeline. We expect to increase our portfolio GLA by 33% or 159,000 square meters by 2026. The larger portion of our mall pipeline will be coming online in years 2025 and 2026, which include our Boracay New Coast Beach Walk, the Capital Mall in Capital Town, Pampanga, and a Highland Mall and Park in Highland City, Cainta, Rizal, among others. Lastly, we are growing our hotel room keys by 3,159 keys, or around 67% higher in the next 5 years. Mar Pipeline is our largest hotel with 1,530 room keys, Grand Westside Hotel in Westside Parañaque, which is expected to open this year. We're also expecting to open Chancellor Hotel Boracay with 554 rooms in our Boracay New Coast Township. Finally, we'd like to end with the following key takeaways from this webinar. For real estate, we saw renewed demand in 2022 for residential units, which all exceeded our targets for the year. We expect the growth to continue in 2023. For offices, we improved our occupancy to 92% in 2022 and continue to grow our rent rates in line with contractual rental escalations. This is despite the headwinds we saw in the Philippine overall office industry. We see rent escalations to continue and vacancies in our portfolio to remain manageable. For our lifestyle malls, we saw a surge in rental income driven by higher tenant sales and the removal of rent concessions. This year, we expect revenues to grow beyond 2019 levels as we work to increase our occupancy. As of January, we're also already charging full rents to all of our tenants. For our hotels, hotel revenues in 2022 already breached 2019 levels from a combination of higher occupancies and higher room rates. We expect hotel to continue its growth in step with improving outlook for leisure and MICE activities. Thank you. So I'll pass this floor to Marco.
Thank you, Andy, for your informative presentation. I know that everyone must be very excited to ask questions, and with that, we will now move on to the question and answer portion. Before we start, let me call on IR Manager April Rose Manyoza to join us as panelist, and she will help Andy to answer the questions. So for everyone's benefit, maybe we can proceed with general questions first about MEG before digging deeper into the other business units of the company. Let's go ahead with the first question related to economic developments and address head-on the concerns of investors on the property sector as a whole. So with higher interest rates and elevated inflation seen to persist this year, do you still anticipate a better performance this year versus last year? What are the current trends that you are seeing so far in terms of customer behavior?
Thank you for that question, Marco. Yes, no, you're right. You know, the real estate industry is currently facing, well, the issues of higher mortgage rates, higher interest rates, which theoretically should impact demand. But for Megaworld, we have not seen such negative impact. You know, for us, it's been improving sequentially throughout the last quarter of last year and into first quarter of this year. You know, we did not see any impact, or at least, you know, we're performing as strong as we had in fourth quarter or third quarter last year. So the main reason for that is 80% of our products are really catered to high-end market. And these markets are really the ones not so sensitive about interest rate changes. We also collect more conservatively for pre-selling condominiums or residential houses, units, lots, all the like. We collect 60% of the property price over 5 years. during the 5 years of construction, and then we collect the 40% remaining lump sum at the turnover date, which is the end of the 5th year. So in that way, it's more conservative in the sense that when they do require to take down a loan, they usually take down a loan when the turnover date comes, when that big lump sum is. So when that time comes, 90% of our customers will just pay by cash, and only 10% of them will only opt to go for a mortgage loan. So this is as compared to peers who may only be collecting maybe 10, 20 to 40% over the 5 years. And then a much bigger lump sum at the end of the 5th year, which may be the reason why we're not seeing any kind of diminishing demands for our residential segment.
That's interesting, Andy. You've mentioned that has been developing at residential properties catered to the upper end segments. We're just curious if this is the forte of the company, or is this strategy deliberate in order to address the challenging environment? So, in related to that, has the company changed anything in terms of strategy or operations, given that interest rates have risen to 6.25% from the 3% average pre-pandemic? And how are you able to manage to grow despite this challenging business environment? Have you offered some relief for the customers, or have you changed the payment terms for the customers in order for the properties to be more affordable from their perspective?
Right. Thanks, Marco. Uh, Maybe going to the first question first. Can you repeat that again, Marco, please?
Oh, so in terms of the strategy of the company, were there any
Right.
changes
Okay.
implemented?
Yeah. So for Megaworld, we've always launched 80% of historically, it has always been 80% catered to the middle, high to high end market. So there's no deliberate change in strategy to cater to at least in the mix of being high end. But of course, we're always listening to where demand is. So for example, right now, if you looked at our launches last year, I think more than half already are of the units that we launched for residential are outside Metro Manila already, because that's where we're seeing demand is going. So we've always acted on demand. So we're never going to launch another residential unit in any given area unless the first project is already 70% pre-sold. So that's a way for us to never not saturate that area. So going forward, it's always listening into where the demand is and launching in that area. And your second question, please, Marco. Thank you.
So how are you able to manage to grow despite the challenging business environment? Are you offering discounts or relief to customers to make your properties more affordable from their perspective?
Thank you. Well, currently, we're actually still raising our prices in line with our semi-annual increases in prices, as with all developers in the industry. What we're doing instead is listening, really launching more outside Metro Manila. In 2022, we launched more outside Metro Manila, and because our business model has always been a township model, so the way we go about opening up or pre-selling a condo in a new area, we first, we always build in a township. So it's a huge piece of land. We'll portion each of the land for different uses, but first we'll launch our residential units first. Whether it be, usually for provincial areas, it's usually a lot to test the market, and then we'll launch probably a vertical project there. After that, we'll of course open up an office space, because that way, there's already spillover to office or spillover to the residential condominiums that we're selling. And when the office and residential projects are finished, we'll then launch our retail segment, which is our malls, because that's a very good way to ensure the foot traffic towards the mall and promise our retail tenants the tenant sales that they want to achieve. So that's always been our business model, and hence why we think we're not as affected. Because when our investors or end users, when they buy our residential units, they always see the vision of the township as a whole. You know, when we sell it to them, it's usually a huge piece of land first, and then they can envision in the next 10, 20 years. It's always in constant development, but in 10, 20 years, especially if it's in the province, that will complete, that is a stark difference compared to, I guess, the other locations in the area. So they want to invest in that lifestyle.
Oh,
And
I see.
yeah, sorry, Marco. And on the pre-selling terms, no, we always stick to 60% over 5 years, and 40% lump sum at the end of fifth year.
Oh, got that, Andy. I guess what you're trying to say also is that the reason why Megaworld managed to grow despite the industry facing some headwinds, it's because of the business model keep focused on township development, and it has been proven to be successful with your Eastwood development.
Right.
And is it fair to say that you're trying to replicate your success with your other township projects?
Yes. So that Eastwood is literally the foundation of
Mhm.
what Megaworld is today. So we try to pattern everything. Well, not everything, of course. We will always make changes to, the challenge of launching or replicating that model is every specific area. There's a specific culture or difference that we need to adapt to. So whatever that is, we will adapt to that. But of course, we will replicate that business model of residential first, office, and then retail.
Mm.
It's always the live, work, play concept there.
Got that, Andy. Maybe before we can proceed to the specific business segments, maybe we can tackle on the balance sheet related questions, specifically on floating rate exposure. How much of MEG's debt has floating rates, and how about dollar denominated debt? And
So yeah, no, so about 40% of our debt are floating, and about 40% is also dollar denominated. So just an update on that. On the dollar denominated debt, that's $600 million. The unhedged portion there is the $600 million in bonds, which was really the cause of why we had 1.7 billion pesos in losses last year. But that $250 million of the 600 million is expired, I think 2 weeks ago. So what we always said in the past few quarters, past few months, is we will refinance it using dollar debt again. That way we don't really crystallize the difference in forex rates, and crystallize the unrealized forex losses, is because the larger portion of the unrealized forex losses are from translation adjustments on the principal amount. But we've also taken note that you know this time around, when peso, 2 weeks ago peso was about 54, 55. It was already much better compared to where we were at late last year, which was 58, 59. So management, we're doing an active role in decreasing our dollar exposure. So of the $250 million, we've already paid that down using $200 million in debt, that's US dollar denominated, and $50 million in cash. So about 20% already we've reduced our exposure in that, and that should bring our forex exposure by around 300 basis points, probably, to 35% from 40%. So going forward, the move is to continuously monitor the forex rates. When it gets better, the challenge before was because this was a bond, we couldn't prepay. When rates were rising, we couldn't prepay the bond because it is a bond. But this debt, the refinancing loan is a debt. So we have the option to prepay that maybe in a year, and really decrease our forex exposure as we go forward.
thanks, Andy. Another question from the Q&A back. Box, any plans of merging Meg with Jerry and Ellie in the future? And what prevents you from doing this up to now?
Well, Jerry and Eli are both under Megaworld. They're consolidated under Megaworld. They are reporting units under Megaworld. Um, so I don't think there are any plans in terms of merging, dissolving Jerry or Eli. Nothing really, but they're already under Megaworld. So
Got that, Andy. We have answered a number of questions already, and we still have plenty of time to answer the questions that we have received so far. And I think we can accommodate a few more. So please key in
sure.
your questions from the Q&A box on your Zoom screen options. Now we jump on to the specifics. The residential segment, which I think accounts for more than 60% of MEG's 2022 revenues. So to start off, where is demand coming from right now, and which segment do you think will drive growth going forward?
So in 2022, demand growth was really broad-based, but demand growth was much faster from foreign buyers. That's in terms of buyer profile, likely as a result of the stronger dollar compared to the peso late last year. So in the first half of 2022, they were only contributing about less than 15% of our reservation sales. But as of end 2022, they were already contributing 20%. So their share of the pie already increased. In terms of demand for at least whether it's vertical or horizontal, we're seeing increased demand for horizontal in the last, at least since pandemic began, which is also the reason we're also starting to launch more horizontal projects in the last few years. So that's one. But vertical development still account for a chunk, the majority of our launches, about 80% of our launches, right? But used to be more than 90%. So now about 80%, but it's still growing. It's just that the smaller part, which is horizontal developments, are growing at a much faster pace.
Yep, and I think Andy, the industry is also experiencing a strong demand from the luxury market, wherein Colliers cites that 34% of demand last year, that 34% of demand last year came from that market segment from just below 5% in 2021. Is that something that you're experiencing right now? And do you still expect the trend to continue this year?
Yeah, so we're usually at the high end segment, but some of our projects may be considered under luxury, but not most, right? There's a certain threshold, but certainly we've experienced that as well. Even coming into 2023, the first few months has been at least very, very okay optics wise. At least the same as what we've been doing, at least in terms of recovery and growth in the past few quarters.
Yep. I guess a question in mind for investors is the disconnect between the demand that developers are seeing for now and the higher interest rates, as I think it's common knowledge that the demand would be weighed down by increasing interest rates, yet it's not what we're seeing right now. So having said that, do you still expect a better year for residentials this year? And when do you feel the impact of higher interest rates will kick in this year? And
Right.
as far as today, are you already helping customers cope with higher housing costs?
Yeah. So to answer your question, Marco, as I said, we were not seeing any kind of decreasing demand from the higher interest rates in the industry, largely because 90% of our customers just pay by cash, right? So in that sense, only the 10% remaining are the ones really affected by higher costs. And if we looked at our cancellation rates, because that would be a good indicator of whether the higher costs are already cannibalizing on their, I guess, day-to-day expenses or requirements for their livelihoods, for their family. No, actually, cancellation rates has been the same for us ever since pre-pandemic. not increased. And this 2023 is actually much lower than pre-pandemic. So we're not seeing higher cancellation rates as well. In fact, much, I guess, lower already this 2023 also. So improving metrics for us. The disconnect really, we can think of ways. Maybe it's because of our township model. We only cater to high end, who has the propensity or the capability to really pay, and really pay by cash at the end of the fifth year. And then we've always nurtured these buyers. They're repeat buyers as well. So yeah. And I guess it's really, yeah, it all boils down to our developments, not being a, as compared to other developers where they can, maybe launch projects single in a single location without any other project supporting it. We always have other projects to support it. So at least our buyers appreciate that.
Thanks, Andy, for that. Just interesting to ask if your expansion outside Metro Manila helps with your demand. What are the disadvantages of expanding in the provinces as experienced by Meg?
Right. Yeah, definitely it has helped our demand, especially because as we, our team has always acted on demand. So we launch, based on optics and of course our data, we will launch in areas that, have good demand for projects. There's low supply of, I guess, good developments in the area. In line with that, we, our townships, we always launch our townships. And because of that, we are able to bring Metro Manila prices outside to the provinces, actually. So I think some of our condominium units outside Metro Manila are already selling at more than 200,000 pesos, which is per square meter, that is, which is a lot. I mean, you can buy a secondary condo here in Taguig City for 200 to 250,000 square meter. But that's, we keep our point that, it's really because of our township model that these buyers really see the vision, and it's an investment, right? 10, 20 years from now, maybe that will be the next Uptown Bonifacio, that will be the next McKinley West or McKinley Hill, right? And that's always the vision in their minds. And the challenges, of course, as I mentioned a while ago, is, there's always certain cultures, certain, I guess, trivias that's related to a certain location. For example, in Pampanga, our township there, capital town, we actually named it. There's one prominent factory there, which is the Paso Deco factory. It was a prominent figure there in Pampanga, but they have since closed down. But but the Kapampangas, I think they really consider that as a historical, I guess, landscape or monument in that area because it's part of their history, which shaped Pampanga as a whole. So we kept that, we used that name in our townships and modeled our township towards that historical importance for Pampanga. So in all of our townships, we always try to do that, listen to our buyers in the area, listen to the locals, and adjust our township model to best cater them.
Okay, Andy. Now moving on to the office segment, which is also a strong contributor in Meg's top line. But before we proceed, we would just like to remind everyone that we are still accommodating questions, and you may send them through the Q&A box below. You also have the option to send your question as an anonymous attendee, and all questions selected to be answered by our panelists will display the name of the participant to other attendees. So moving on to the office, at which locations do you see improvement in occupancy and which locations are not showing improvements and what drives this?
Thank you, Marco. So for Megaworld, Iloilo and Taguig City has always been our crown jewels of our office portfolio. So Iloilo has 100% occupancy rate. So our problem there is actually Supply, we need more supply to, cater to the growing demand that we can't even give space to. And Taguig City, which is 97% as of last year, 97% occupied. That's in our townships in Uptown Bonifacio. So Uptown Bonifacio is a township of Megaworld, and McKinley West and McKinley Hill. So those townships, 97% occupancy, steadily improving because of the low supply. Overall, also in the area, even amongst the other office landlords. I think the challenge, or where occupancy has not been improving in 2022 specifically, was in Metro Manila, was in Eastwood City. We've always mentioned that the demand dynamics in the office market has shifted. At least from our point of view, what we're seeing is that demand is now much smaller, in the sense of it, they require smaller space requirements, mainly because of the work from home scenario, hybrid arrangement. All these tenants that have large office spaces, their expansion plans are basically okay already for the next few years, because they can just send some employees to their house and fill some of the office space that's because of the work from home arrangement, basically is larger already. They can accommodate more employees. So their expansion plans stopped, the bigger tenants, but we're seeing more now from smaller tenants. So these are SMEs, MS micro, small, medium enterprises, startups, and the like. So these are the types of companies that are just expanding much faster right now. So our office team did the work in 2022, and which was the only reason why we managed to grow our occupancy rate to 92%, whereas the industry, I think, fell by 1%, right? So we all managed to go against the industry because they did the legwork, and really put in the effort to book these smaller tenants. There could be hundreds of tenants, but essentially the total transactions, in square meter, when we measure it in square meter, still rose by 9%, year on year compared to 2021. So that's the demand dynamics in the office industry. And going back to Eastwood City, why it's such a problem? Well, not a problem, but it's much more difficult for us to increase our occupancy rate there. It's because these buildings are much older buildings, and these buildings have larger cutouts. It's usually by floor that you rent these buildings out. And because of the demand for smaller spaces, it's harder to lease out these buildings. But we're continuing to lease them out. It's improving, albeit slower than the rest of our areas in our portfolio. But we're continuing our renovations, our improvements in the buildings to increase, of course, the attractability of these buildings.
Thank you for those insights, Andy. Maybe we can proceed to the next question. I think this pertains to the one of the biggest concerns in the office sector last year. The future of the Pogo industry in the Philippines has seemed uncertain lately. How exposed are the offices of MEG to this? And maybe you can share your insights on how you think this will pan out.
Okay, so pre-pandemic, I think in 2019, at the height of the Pogo boom, MEG's office portfolio has more than 10%, I think around 13%, if I remember correctly, of total gross leasable area that's occupied by Pogo tenants. But of course, we, in line with the industry exit as well, we've had an active move to really replace them with more stickier tenants, whether it be BPOs or traditional tenants. So right now we're at around 5% only of our portfolio. That's down from 13% in 2019. But our so that's effectively eight percentage points that went out just because of POGOs. But our occupancy, our overall office occupancy is still at 92%. So we've effectively replaced most of them already with secure tenants, and much safer. So yeah.
Yeah, I see. Got that, Andy. Is the vacancy in Eastwood related to the pogo industry? And how do you plan to address the vacancy in Eastwood?
Not at all. If I remember correctly, not at all relates to the pogo industry. But it's really the vacancies has been there ever since. It's really I guess the lack of demand for larger floor plates. You know, when they maybe when they renew their terms, they don't renew their terms anymore. So we've had some cases of non-renewals in Eastwood, in only in that city. So it's more of that, um, of our traditional NBPO tenants. But most of these tenants that have exited are usually still our tenants, but they did not exit completely. They still rent in the same building, but they just downsized.
Oh, got that, Andy. So is it safe to assume that you're offering lower lease rates in that area in order to fill up those spaces, but overall you were able to increase your rates on your
Right.
entire office portfolio?
Yeah. So on the optics of rent rates in in key locations in Metro Manila, our rent rates in 2022 are flat compared to 2021. But it's good to know that we have never decreased our rents, even compared to pre-pandemic. Right, it's a move by management, by the decision makers in our office team to never decrease our rent rates. What we'll do, however, is be more flexible in other areas of the lease, whether it be a longer fit out period if they need it, or a more accommodating expire or uh, renewal rate. So usually when they renew their contracts, there's also an increase when they renew. But I think recently we don't, if they, you know, in order to keep our tenants, we can opt to not to impose that renewal rate, the hike when they renew. But still the annual increase will still be in play in their contracts. But in outside Metro Manila, our rents are still higher. It's growing, as the same as it used to. So that's the only reason. So in Eastwood, no, we have not decreased our rent rates. Which, you know, what we're doing is really making the building more attractive and revitalizing the building itself. And to because these are older buildings as well. So aside from rent rates, that's also a big concern for our or any prospective tenants. Would you prefer to go into a new building or an old building, right? So we're doing major renovations, major works there, which we have said in line with MREIT, which was the biggest reason for the rising costs in MREIT, is really to revitalize these buildings.
Understood, Andy. Maybe we can move on to the next segment. Malls. Have foot traffic and tenant sales reverted back to pre-pandemic levels?
So well, our tenant sales are already 6% above pre-pandemic levels. So basically overall, because we track our tenant sales by each tenant, so because they have a POS system, so we track it, you know, all of overall it's 6% higher already than 2019. So they're fully recovered. But foot traffic for us is still at 70% of pre-pandemic. So still about 30% lower than pre-pandemic. But we don't think this is an issue for us, because of our business model. Because our business model has always been a township model. And as I said, we launched residential units, office units, and that office building there will be the quote unquote guaranteed foot traffic into the mall. And because of the work from home scenario and a hybrid setup, there are less and less office tours, which really impacted the foot traffic in our malls. But as a whole, they're spending more now, so their average basket size is more than 50% high, or at least 40% higher already versus pre-pandemic, which accounted and really made the difference for us to recover to more than 100% of tenant sales. So I think even compared to peers, tenant sales, we're about at the same recovery rate, more than already above 2019 levels. But foot traffic, we're lagging behind. But we think it's only largely due to our township model, where we rely most of the foot traffic from our off or nearby establishments from us.
Got that, Andy. And in relation to that, are you also repurposing your space? So is that it does not clash with growing e-commerce business? And how is online retail affecting your long-term strategy?
Right. So no, we have some repurposing projects in some of our areas with in Eastwood. I don't think we can announce these yet, but there are, of course, some strategy to bring foot traffic back to the malls, also to combat the online retail. So just to share, the biggest performers of our tenants are the food business, entertainment business. These are the bars, the party places, the discos. So these are the types of business. Supermarkets that are doing very well, and growing way above 2019 levels already. So we're skewing. I think over the past few years, we've already have more food and beverage tenants. And that has always been our strategy, is to make our malls be a destination for our mall goers, rather than just be a shopping place. We want it to be a destination. They can dine, they can do some activities and shop on the side. So definitely, we always try to fix or to cater to where the market is going now.
Okay, thanks for that, Andy. Maybe we can proceed to hotels. Were there specific strategies that led to increase in hotel occupancy last year? And maybe you can talk about your performance in Twin Lakes.
Right. So in 2022, the largest difference was we spent really more on brand building Megaworld hotels. I'm sure not a lot of people, at least in the Philippines, or especially outside the Philippines, know about Megaworld hotels. We are the largest homegrown brand, which is really not, we're not tied to any international name. So it's really building that brand. And because of the return to local tourism, Tagaytay really was, they had a good year. Tourism to Tagaytay, mostly, I think even foreigners were going there. And they really liked the view of Tagaytay Twin Lakes Hotel. And that was the reason why it performed very well. So this one here, April is showing here a slide for Twin Lakes. Our occupancy really increased by a lot, right, from 20% at pandemic lows, because this is really a tourist hotel, right? But even compared to 2019, we continued brand building and really, I guess, the revenge tourist spending improved our tenancy, our occupancy to 95% in early 2023. So
Thanks, Andy. I think we can still accommodate a few more questions before we end the session.
yep.
Maybe we can go back to general questions. So, given the sell down following the deletion in the PSEI, MEG is now trading at a significant discount to its NAV. What upside catalysts does management expect this year for the stock to re-rate?
Okay. Thanks, Marco. No, well, for us, we also, of course, our management, and we do recognize the large discount compared to our NAV, even compared to our price to book value, more than 60%, more than 70% discount, which for us is really unwarranted. I mean, when we look at our operating stats, our performance for our earnings, we're doing very well, if not better, compared to peers. So it's only a matter of proving that we're, that our company, our businesses, there's always headwinds, right? There's headwinds in the office sector, that there's headwinds in the residential sector, even retail sector. Any given point in the year, there's always concerns on that, which we think really affects as a whole, not only us but the whole property industry. I think the property industry has derated in the past few months already, right? So when the ongoing concerns, when we report our first quarter earnings, or when other peers report their earnings this year, and things will still, the pace of recovery and the growth will continue to continue, then we think that should be a good testament to the quality and the stability of our earnings, right? For us, I think the biggest concern for us really is the forex exposure. Specifically for us, it's the forex exposure. We have 40% in dollar debt exposure, which caused a massive 1.7 billion profit, unrealized forex loss last year. So but in the past few years, we've never really, because the dollar hasn't gone haywire back then, but in the past few years, we didn't look to decrease that, because it was still fine in the past few years. But late last year, we started to realize that we will pare down our dollar exposure, and we will never borrow in dollar again. I think that's one of the concerns of the market as well for Megaworld as a company, is that we continue to borrow in dollar, when in fact we don't have any dollar hedge, natural or artificial hedge. But for us, borrowing in dollar is much cheaper, 30% cheaper, compared to peso. So that was the rationale for borrowing in dollar. But of course, when the forex rate goes south, then that all goes to that all goes to, well, very bad, right? So right now we're really actively decreasing our forex exposure. I think once we effectively remove a significant chunk of that, we may see some re-rating. That's our point of view, but of course, it will all depend on the investors.
Got that, Andy. We still have a lot of questions in our Q&A box, but in the interest of time, I think we can only accommodate one more question before we wrap up the event. So the last question is, can you share your plans for MREIT in terms of expansion? And are we still expecting more infusions to come for the rest of the year after what has been disclosed early this year?
Right. So the plan is to grow MREIT's portfolio by 500,000 to 500,000 square meters by 2024. So by next year, we're growing our portfolio by 54%. The focus is still on the office buildings, of course, but we are always monitoring and really flexible on what we plan to acquire. But right now, there's still no official announcement. It's still office for now, and we're planning. Of course, we realize, even if rates are higher, we still have to grow as a REIT company. So we will have to acquire in the next 2 years, this year and next year, and reach 500,000 square meters by 2024.
Thanks, Andy. I believe that is all the time we have for our Q&A. And for those questions that we were not able to answer, we will get in touch with you to discuss this accordingly. Thank you all to participants who have asked their questions, and to the panel for insightful and informative discussion. Before we conclude, maybe we call on Andy again for his final words for our audience.
So, well, thank you everyone for joining today. I'm sure the market is there's no direction for the market, whether it be for the overall PSEI or even Megaworld stock. But rest assured, we're doing our best here. We're continuing to exceed expectations of not only ourselves or internal expectations, but also of the analyst estimates that's effectively seen last year. This year, we hope to bring in 20 billion pesos in leasing revenues that's combined from office and malls, and hopefully to continue our growth in residential revenues. And at earliest this year, we hope to already reach 2019 levels. So we're already growing past 2019 levels. If not, then the latest we'll see is in 2024. So that all really depends on our residential business, our residential revenue booking. But in looking into malls, offices, and hotels, we're already targeting, already assured that we're already targeting to reach or grow past 2019 levels this year.
Thanks again, Andy and April, for spending your valuable time with us. On behalf of BDO Securities, we'd like to wish you the best on this offering. And again, thank you everyone for joining us this afternoon. This has been your host, Marco Maulion. Please stay safe and enjoy the rest of the day.
Thank you.
Trade stocks online with BDO Securities anytime, anywhere. With BDO Securities' online trading platform, you can easily open an account, do real-time funding and withdrawal, and stay updated with market insights and trade ideas. All these to help you make informed decisions as you grow and manage your wealth. Whether you're new to investing or a seasoned investor, BDO Securities will give you access to a comprehensive stock market experience. Visit www.bdo.com.ph/securities to open an account today. Trade stocks online with BDO